Glad you could join us today here at Bogart Wealth as we talk about the 2024 year-end planning and what are some of the actionable items that we can help you think about that you can address within the last few weeks of the year, and then certainly looking to 2025 and beyond. We had some recent changes with the most recent election, so I think there's also something to talk about, not just, hey, what do I do with the last two and a half weeks of the year? What should I be thinking about looking towards next year? We're going to spend some time talking about that today. The Q&A is open. I'll do my best to answer those questions as they come live. If not, then we can address those at the end of our seminar today. So I will be looking at the Q&A as we go on. Numbers kind of settling out, so I think we're good to start. My name, everybody, is Brian Windsor. I am a certified financial planner here at Bogart Wealth. Really happy you could join us for this discussion today. Let's get started. So before we jump into, the actual, talking points of today, let's get a lay of the land. I mentioned 2025 and beyond. We're going to look towards that, towards the tail end. But what are the couple of items we need to be thinking about, or should be at least cognizant of, as we get closer to the end of the year? First and foremost, we're going to look at your company benefits, have discussions about your current saving strategies. What are some of the things you need to make sure should be done by the end of this year, or are there certain things that you may have a little bit more time to consider? And that's going to sort of tie into the tax planning that you're possibly looking to do, whether it's for today, also looking into the future as well. So what are some of the things I can do today that could help with or possibly be a benefit from a tax planning perspective? That ties into one of those techniques that we see a lot of as we get to the giving season, charitable giving. What are some of the ways that we can gift? Is it cash, securities? Does it go to the charity? Does it go to an advice fund? What does that look like? And then last, for 2024, which is certainly a must, make sure we take out those mandatory distributions. We'll talk a little bit about the updates that have happened as of the last few years with the Secure Act, making sure that they get pulled out here. So if this is your second time taking required distributions, certainly we have to get those done by the end of the year. If not, if it's your first time, you get a little bit more of a lenience with the IRS. Might not be the best way to think about it, though. All right, so let's talk about Bogart Wealth. If you're already here and you're already a client of Bogart Wealth, this is probably pretty familiar with you. If you're new, welcome. We love having new individuals join us and a little bit about the firm that's based here, where I am in McLean, Virginia. It was just absolutely pouring down rain a few minutes ago, so you actually can see something behind my desk and not just puddles of rain. But McLean, Virginia is where I'm located here. Bogart Wealth is about a $3 billion size firm. We are independent registered investment advisors. What does that mean? Well, we are fiduciaries for our clients and helping them make critical life decisions to provide them financial peace of mind. We partner with our clients on a one-to-one basis to help detail financial planning, help them integrate that with investment management, tax planning, and tax prep work. Over 1,300 households across the country look to us as their primary financial advisors. And so we help them on an ongoing basis. Typically, our cadence is quarterly with our clients to help them with anything from estate planning, tax planning, financial planning, cash flow. We'll talk a little bit about what that means, but as a fiduciary, like I said, we put our clients' interest at first. List of advisors. We have a pretty deep bench here at Bogart Wealth. The majority of our advisory team are certified financial planners. Guys, this is the gold standard. So if you're looking at us at the first time and you're interested to know more about how we can help you, obviously give us a call. Let us know how we can help. But just know that the majority of our reps here are, have what's called the gold standard, in my opinion, of an advisory that you work with. So a pretty deep bench of team members that can certainly help support you. But that's not just it. It's not just, we're just not a team that is just full of advisors, but the bench here is also pretty deep with our marketing team, our operations team that sits right out the office here, as well as our financial planning team that you see here on the screen, and also our investment management team led by Alex Spencer, our chief investment officer, him and his team. So we do the majority of everything we do is in-house. And so I think if you're thinking about a firm and who should I be partnering with? It's really nice that I can just go out the door and ask the people these questions, and we don't farm those businesses out anywhere else. So our presence is here is in McLean. That's the building I am in as we speak. And then we also have a few of our offices down in Houston and the office in the Woodlands. So if we're local to you, great, come stop by and see us. And if not, certainly a lot of our clients, mine are all over the country. So we do meet a lot over Zoom, and it's going to be pretty convenient for everybody. This is the heart and pulse of Bogart Wealth right here. This is how we work and operate with our clients on an ongoing basis by creating a detailed financial plan that's customized to their needs and desires and their family members, right? So as we're looking to make these decisions about, well, I'm retiring, can I retire, or how should I be taking cash flow from my retirement accounts? How does this all correspond with you, your spouse, your children, right? How do the decisions I make today impact them in the long run? And if it's not children, is it charitable organizations? And how to be thinking about what my specific and unique plan is, and how should that, integrate with my financial plan? And I tell you, life changes. You guys know this. The way you were planning for any sort of life events, maybe even 5-10 years ago, changes. And here we are at the end of 2024 on this, the cusp of a new year. And, with that can certainly come new changes. We're going to get to the meat and potatoes of our conversation today, but just as fiduciaries, as our mission is to help to empower individuals through financial education and literacy, do know that on our website, bogartwealth.com, just a plethora of information that's available. Our webinars are saved. You can go back and see how we've been having conversations previously. And if there's also other things that you want to see that's not listed here, you don't find on the Bogart Wealth website that would be really beneficial to you and some of your colleagues, shoot us an email. We're absolutely happy to put together new content for our clients and their family members. Okay, stretch out a little bit. Let's get into it. We're getting to the end of 2024. And so that being said, what are some of the things that we have to do by the end of the year if we're looking to maximize our employer-sponsored benefits? For a lot of us, it's our workplace plans, our 401ks, 403bs. Currently, right now, any individual can put up to $23,000 of their own money into the 401ks. So take a look at your statements. If you are looking to max out, and it's nice if you're able to, if not, do what you can. Any little bit helps. But if you are looking to get to that point of putting as much as you can in there, take a look at your contribution statement. And honestly, I would probably do it today if you're thinking about it, because it may take your if you have to make any sort of updates or tweaks to get to that number, it takes your payroll typically maybe a payroll cycle in order for that to kick in. So you might only have one more paycheck for that to go through. So that would be something I would look at now. And if you're over the age of 50, hey, welcome. You can do another $7,500. So for you, you have the ability of your own money going up to $30,500. So again, take a look at your statement, go to your employer's, the institution's webpage and take a look. We're going to get into this in a second with defined contribution plans. This is 401ks, 403bs and such. The total maximum between you and your employer is $69,000 for the year. I'm going to speak about this in a later slide about, again, this is if your company allows it, not all of them do. There could be a way of doing a little bit more into your workplace plan as long as it doesn't go over $69,000. And then if you're over 50, that add the other $7,500 in there because you can do a catch-up contribution. Okay, again, year end. We talked about employer plans on the savings side. Let's talk a little bit about college savings plans. 529s are the most heavily used accounts for college savings in the United States currently. And each state may have their own tax savings for funds. So 529 plans, we have them for our children. We have 3 little ones at home. And, putting money aside, living in the state of Virginia, there is a benefit for doing that as we get deductions off our state income taxes. Some states have different rules, different regulations, but if you get contributions in by the end of the year, then you may be able to take advantage of those state tax deductions. The maximum amount that you can put into any or gift to any individual, it's including your children or your mailman down the street, if that's how you so choose to gift your money, but it's $18,000 per person. So with me and with one of my children, I could actually technically go up to $90,000. And that's what we call front loading your 529, where they allow you to say just for 529s. And so this is estate planning, depending upon the size of your estate, you may consider front loading it, where you put in $90,000 right now, which is 18 times 5. And so that's the maximum amount they let you to do. So they allow you to front load it just for 529s. You can't do that with any other types of accounts. So I put in $18,000 this year. Well, I put in $90,000 and they counted for $18,000 the next few years. So I couldn't do anything for 5 more years, but hey, I got the money in there. And again, especially from an estate planning perspective, could make some sense, but that's why everyone's different. Health savings accounts. Okay, so workplace plans, that was one. We talked about 529 accounts. Let's talk about our health savings accounts. There are maximums that we can put in each year, just like with our 401ks and 403b, HSAs, our health savings accounts, which can only be used for high deductible plans. So if you are currently with an employer or have a high deductible plan, if you have a high deductible plan, period, you can contribute up to $4,150 if you're single. But if you have family status, $8,300. And I mean, HSA accounts, if you're not familiar with it, I can put that money in pre-tax, it grows tax-free, and I get to distribute it tax-free for health-related expenses. It's a triple tax savings. So yeah, I want to make sure that if I have the ability to do so, might be something to be thinking about, because healthcare expenses rise. We certainly, within our detailed financial plan that we do, we look to rise healthcare expenses faster than everything else. So more you can put in there could be beneficial. If you're over 55, excellent. Another $1,000 you can put in there. It's not used as much anymore. I remember I had one when I first started in the industry, a flexible savings account. This is a little bit different. If you still have them, you can go $3,300 per year. If you're married, they can also do another $3,300. These are monies for healthcare related expenses. However, they have to be withdrawn in the same year as well. So there is a lot of I remember the CVS in Baltimore. I was gearing up on gauze bads and certain things just to make sure I was maximizing my benefit where I didn't lose the money. Now, some employers allow you a grace period, typically a few months afterwards. So it might not be 12/31, but if you do have an FSA account, you're probably familiar with this, but you typically have to use it or you lose it. Okay. So I want to dive a little bit deeper back into 401k strategies. We talked about maximizing contributions and the amounts. Let's talk a little bit about some of the unique things that you can do within the 401ks. And this comes into one of our series that we have on the Bogart Wealth website, is the Mega Backdoor series. And Mike Camara, if he's your advisor, you know how fantastic he is. But he does a great, 60 minutes talking about this really in depth. But what this is if I have after-tax money in my 401k or for my paycheck, and I can put money in there after tax money, I can then, immediately move that over to a Roth IRA, a Roth 401k, where again, if you have that 23,000, that's your maximum employee contribution for either pre-tax monies or Roth monies. Sometimes, again, they allow you to do an after-tax contribution on top of that amount, on top of that 23,000 or 30,000. If you're doing catch-up, you can do above that. That's an after-tax contribution. So I don't get any benefits now of deducting that money, but it's in there. And so if I keep it as is, I don't do anything, it's going to stay in the middle. It's going to be this traditional source, meaning I have after-tax money, and then the earnings that grow on that grows tax deferred. So again, nice thing, I don't have to pay any taxes and it grows tax deferred. But wait a minute, if they do allow you to then move that over to a Roth source, that's that backdoor conversion. So that might be something to be thinking about as we get closer to the end of the year. And I'm looking specifically at that left mark here, that after-tax contribution, because a lot of times we save on this this after-tax money, maybe after we've maxed out our 401k, after we've gotten that 23,000 of pre-tax money, we just have some excess funds, and then it goes into this after-tax source. However, this is not for all, but some workplace plans also allow you to cut a check at the end of the year to fill it up. So this is a pretty busy chart. Mike goes over this in detail, but what this really means to you is that check with your employer at the end of the year, as we are right now, and see if you're eligible for a special contribution where you can basically monies that you've been paid that's been sitting in the bank account, and you want to get closer to that maximum amount of, say, $69,000 or so. There could be some wiggle room. And again, if your employer allows it, if you just say, hey, I can make a special contribution. And for this individual in this scenario, the numbers allow them to do $11,250. So that just gets sent in, and then they do the backdoor conversion from there. So again, some unique things that you can do, but this specifically, this is the time. If you are eligible to do it or interested in doing it, your benefits, or whoever's running your 401k, 403b should be able to guide you through if this is something that you can look into. Yeah, same thing. This is that backdoor contribution where I put that after-tax special contribution into that 401k, and then I can immediately move that back out to a Roth. Okay, so I think at this point, we've covered the workplace side. What are some of the things from our work benefits and college savings that we should be thinking about? Now we're going to transition talking more about everyone's favorite topic, taxes. If you're a single filer in 2024, this is your tax chart. We have a progressive tax rate in the United States. So depending upon your overall income, any individual that has between $0 and $11,000, that income is taxed at 10%. Then on income of $11,600 to $47,000 of income, that's then taxable at 12%, and so on and so on. So it's interesting to see that as you're thinking about your current taxes and maybe even looking to next year, I got some expenses upcoming. And, if I need to withdraw anything from my retirement accounts, those pre-tax monies I was putting in there, I need to do a withdrawal. Do I do it now? What's next year look like, right? Next year's tax brackets are out, by the way, if you want to take a look at them. Everything's just elevated up a little bit. But just determining, as far as planning it out, well, gosh, if I take that big withdrawal next year, I'm going to be, pushing that 32% tax bracket. So those monies are taxed at 32%. Why don't I do some now and some later? So I'm going to stay in the 24% bracket. If you're looking at the chart here, you see that there's the marginal rate. That's the dollar amount that monies in this bracket are taxed at. So again, every individual in the United States, any income between 0 and 11 grand is taxed at 10%. Then 11.6 to 47, that's taxed at 12%, and so on and so forth. Average rate over here is looking at, okay, what's the amount that I'm paying in taxes versus my income? Divide that. That's the average rate. So you see that the higher I go, some of these, not all of my monies, if I'm in the 35% tax bracket here, and I'm, not all of my money's taxed at 35%. Some of my monies are taxed at the 10 and the 12. So in the aggregate, for every dollar I bring in, 30.1% of that has to go to taxes, just to account for what the averages are. And then if you're a joint filer, you have a little bit more of a wiggle room here with the brackets being slightly higher. And again, progressive system. And same thing, if you're looking at income, taking a distribution this year or next, kind of looking at where you are so far this year. And that's one of the things that we help with too, by the way, with the tax team that we utilize. We have them run intra-year reports and saying, okay, where do you stand right now? And if you're a client of mine, you know that the majority of us have had these conversations throughout the year and, are looking at what additional wiggle room do we have for the remainder of the year, whether it's for things that we're going to talk about in a few moments, like Roth conversions or even distributions. Like, how much can I do and not sort of spill over into that next bracket? But then that next dollar, again, it's not taxed at 24%, but now it's taxed at 32%. So monitoring that. This is one of my, like, I get excited about this, uh, more so than anything about taxes, is the understanding that there's a difference in taxation between income and capital gains qualified dividends. So in the tax code, if you have a long-term capital gain, I hold the security for more than 1 year in a non-retirement account. So this is not like with your 401ks and 403bs, IRAs, those are all tax deferred accounts, but like your normal investment accounts. Obviously, if you have those, you know that, if you do sell something, you have to pay capital gains, but that's a relatively, for most people, lower taxes to generate the type of capital that they need. But what gets me excited is depending upon your income, there's actually a way to keep your long-term capital gains rate at 0%. And that's not, again, not everybody has the ability of doing this, but some individuals that are just living off of dividends or interest, or just Social Security or so, and they're comfortable with that, depending upon their income for the year, 47 single or 94,050 joint, capital gains and all other income, if it's below $94,000, you pay nothing for it. So I have many clients that are just living off of Social Security or dividends, or just living off cash that they've accumulated, and their tax rate's really low. So we can say, well, we can start selling securities for you. And oh, by the way, this is the amount that you can sell, and you probably don't have to pay any taxes for this at all. Pretty nice, right? So again, not for everybody, not everyone's in this income situation. But the other sort of caveat to that to be mindful of is also that could also change how your Social Security is taxed. So again, I gave you the example earlier. If you're just living off of Social Security, then you could sell some capital gains. But keep in mind that Social Security, if your income is at a certain point or lower, nothing is taxed. So all of a sudden, if you add capital gains towards that, now you're finding out, well, I don't pay any dividends, or sorry, I don't pay any capital gains. I don't pay any capital gains on that selling in my non-retirement account, but because my income is now, I don't know, say $90,000, now I got to pay Social Security taxes. So be mindful. It's hard. This is tricky. This is why we're here, to help navigate all this for you. But again, depending upon what your income is for the year, your total income for a year depends what your capital gains are. Getting to the end of the year, I mean, this is what's hot on the phones right now with our clients as we're looking at tax planning and making sure that these get done by the end of the year is, deciding, are we doing a Roth conversion? And if so, what are the numbers or tax bracket we're looking to go through? Everyone's different, but what we do with comprehensive planning, and we can look at your assets and your cash flow, and, with conservative market projections, just get a sense of what your marginal tax bracket's going to look like throughout your lifetime. Here's an example of somebody that's retiring now, and their tax rate's pretty low. You can see that here. I don't know if that Zoom does that or not. You can see your tax bracket on the right, where 2024, and for a while they're an extremely low tax rate, as they're, in this case, this person's living off of non-retirement monies. Like we talked about before, tax rates there are relatively lower. So their tax rate's pretty low here. But then in 2037, they turn the age of 75. Because of the new Secure 2.0, that is when their required minimum distributions start. Minimum distributions have to come out. Congratulations. You've saved in these accounts long enough. The IRS says we want some of our tax revenue. So you're forced to take some money out. And so based off of this person's projections, that's going to elevate them to the 33% tax bracket. Not uncommon, especially if you're allowing your, in this case, tax deferred assets to grow for 13 more years. Yeah, that's a great issue to have. But the more we know now, the more we can work around this. And that's where here we get a sense of this individual. This is future value money. So it's not in today's dollars. These numbers are certainly lower. But with the Roth money that they have right now, estate's 18.4, the investable estate at the age of 90 is projected to be $18.4 million. So excellent job. 740,000 of that is completely tax-free to your kids. That's Roth monies. The 7.7 of tax deferred assets, this is what's left over in your IRAs, your 401ks, and your pension. $7.7 million goes to your heirs. For a lot of us, it's our children. Well, you're probably aware, if you joined us here before, we talk a lot about the Secure 2.0 Act, but if you're new to this, quick runaround is that, your heirs will now have to take this out over a 10-year period. Not your spouse, that goes interchangeable, but your heirs, children, when they receive this, $7.7 million will have to be liquidated within 10 years of your passing. Depending upon where your kids are in their life and their earnings, a lot of these monies could end up being eaten by taxes. 9.9 million, these are non-retirement assets. These get a step up in cost basis, which is typically a nicer way to give monies to heirs as well. So as we're looking at more detailed financial planning and understanding our clients and desires, and I hear it all the time, I want to make sure that we're comfortable, but I certainly want to be able to be smart about how I'm leaving my legacy to my children. This is where we get to the end of the year. We look at Roth conversions. Does something like this make sense for you and your taxes currently? Like, are you projected to save some money? Like, what's in it for you? Or do you have a benefit? But then also, what are the benefits this provides to your heirs, your children, the next generation? Here's where we look at, okay, what if we went ahead and filled up the next tax bracket? You're in tax bracket X. What if we went to tax bracket Y? We did those conversions up till you turn required distribution age. You see on the right, estimated amounts as our tools are running the mini 1040s in the background, get a sense of what you can convert. Still leave about $18 million to our heirs in future value, but a third of that now is completely tax-free. I didn't mention this previously, but with the IRAs, the tax-deferred assets, in this case here it's 5.4. You have to take this out over a 10-year period. Same thing with the Roth, these tax-free assets. But they still grow tax-free, and then you can withdraw them tax-free. So it also gives your heirs, that next generation, a 10-year tax-free window of growth if they want it to. So it gives them more opportunities for growth. So in this case, by doing these conversions, totaling up about $1.6 million, I'm going to do that over the next few years, and now a third of my estate is completely tax-free to my kids. So that's certainly a big value add to looking at how your legacy can truly impact your kids and not be a burden on their taxes. First world problems. The other thing that was I didn't include on this slide, I should have put it on here, is the tax savings too. And so understanding that when we look at doing these conversions where, look at this, we're adding a lot more income over the next 10 years. But then what does that do as far as lowering their required distributions? And then if it lowers their required distributions, because I don't have to take required distributions on Roth assets, then what's my tax bracket in the future? It's obviously going to be lower. So what's the alpha? What's the delta? In this case, it was pretty apparent that there was going to be some significant tax savings for doing this as well. So even though I'm adding taxes now, by removing that money from future growth and pre-tax monies, and now all that growth is going into the Roth, now I have the ability of having that growth on the Roth. So now my future required distributions are lower. So now I can project lower taxes in the future. And then we run the delta to determine, okay, does it make more sense to do this or not to do this? In this case, it was pretty significant. Did I understand correctly that heirs of Roth monies must withdraw it within 10 years if non-spouse heir? Yeah. So if somebody's passed, if they passed away after 2020 and they have inherited a Roth money, and if it's a non-spouse, those have to be withdrawn within 10 years. That is correct. Okay. Let's transition out of the world of retirement year-end and retirement account year-end, talk non-retirement year-end taxes. If you've been in looking at your portfolios for 2024, most clients I've talked to have been pretty happy with how things have been going. So we don't see a lot of these right now. Again, good problems to have for us is that I can sell a security in my non-retirement account, and if it's running a loss, well, I can use those losses against my income, $3,000 a year. I could use that loss against any additional gains that I've had this year, or if I don't need it, I can just kind of punt it to next year and carry them forward. maybe if you've had some gains in your accounts this year, take a look at your tax forms. Maybe you have some losses from years like 2022 when the markets were obviously pretty poor at that moment. Maybe some losses were created then, and maybe you carry them forward and you can use them against gains for this year. That's going to be on your tax returns. So if you want to take a loss and have it for 2024, it has to be done by the end of the year. So again, we've had a good year so far. Not many clients that we're seeing are showing a lot of losses that they can take, but nevertheless, if there's anything that's there, certainly you have that opportunity of utilizing it. But when you do, this is the compliance talking. You just can't buy it back within 30 days. That's the wash sale. They don't let you to, sell something and rebuy it just so you can book the loss. They say you have to wait 31 days. So just wait 31 days. If you see something that you really like, but you just want to book the loss, buy it back again within 31 days, unless you buy something similar in nature. So it doesn't have to be identical, but something different. You could still be in the same places of the market. It just can't be identical. Yeah, we mentioned this. Tax losses, carry them forward, or I can use them $3,000 against my taxes on any given year. And then losses can be carried forward until future years until exhausted. I remember I had clients that took losses in 2008 and they still carry them forward to, I think, 2018, 2019. So, you never know. Okay. Let's get out of non-retirements. Let's talk about charitable giving. This is the season, right? I mean, if you've gifted to charities before, they're active, and this is when most donations occur in any given year. So how do we be smart about this? How do we think about charitable donations and give to those organizations that we feel that we support and that we want to do good for? But how can we make sure that we're doing so that also can be mindful of our specific situation and some of the things that could help us from a tax perspective? So first and foremost, we're going to talk about qualified charitable distributions. These are called QCDs for short. Individuals, if you are over the age of 70 and a half, which used to be the required minimum distribution age, now they've changed that. They haven't changed qualified charitables. They can transfer up to $100,000. It's actually $105,000 now because they changed it for index for inflation. So it's $105,000 this year. It'll go up next year. But I can move monies from my IRAs, not your 401k. Yeah, say Will Robbins. Good for you. Good catch. I didn't see that, but Will Robbins and me are friends. You can, it has to be from your IRA. Some of your workplace plans, you can't do this from your 401ks. They only let this from your IRAs. But I can move money from my IRAs, and if it goes directly to a charity, then that money's out of my estate. I don't get a tax deduction for that. I don't get that lower anything, but I can push that to the charities that I support. We usually see this a lot more for individuals that are charitably inclined and they have required distributions. So for those that are now 73 or later on when they turn 75, depending upon the age, I'll touch base on that in a second, that instead of taking the required distribution to themselves, they then pushed the amount of monies to their charitable organizations directly. Again, I don't get it as income to myself. I don't get a deduction, but I don't take it as income to myself. So if they're going to pay you, if you're going to have to take a distribution anyway, might as well push it right to the charity if you're going to give the money to them anyway. So that's what we can do around the age of 70 and a half. But before then, what are other ways that we can gift to our, organizations that we support and love and hold dear? Well, you can give. A lot of people write checks, send the checks out to the organizations I support, or if you're aware, I can donate stock to them. A lot of charities have their own brokerage accounts, and you can push securities towards them. And a lot of times, if you're looking at what's a smarter way of doing it is, well, if I have stock, maybe grandma and grandma gave it to me, I don't know what the cost basis is, or maybe it's a stock that I bought and it's done really well. And I'm thinking about selling it, but I don't want to sell it because I sell it, I got to take a gain. And I'll come back to that, Will. Instead of taking the gain, and then taking the cash and giving that money to the charity, because if I take a gain, I got to pay taxes on it. But if I just give them the security without selling it, I get a donation without a gain. Another way, this is donor advised funds. Donor advised funds typically allows you to simplify the process, where instead of having to go and push money out to each different organizations, we custody at Schwab. So Schwab Charitable, I can move my stocks directly into Schwab Charitable and then go onto the Schwab Charitable site and gift monies out right from my computer. Checks go out automatically. Maybe though I'm not ready to give yet. I'm not fully aligned with where I'm gifting my monies yet, or maybe I want to do a large gift this year because I'm looking to get some benefits from taxes. Because if I'm doing, ties into Will, yeah. If I'm itemizing, or if I'm looking to itemize, if I do a donor advised contribution, and I'm just going to say, hey, I want to give $5,000 a year to my church, but that doesn't help me itemize, so there's really no benefit. But what if I gift 10 years worth? Let's just say I could do that. And then so I move $50,000 into my donor advised fund. I could actually get a deduction now because now I could itemize, and then the money stayed in the donor advised fund. And then every year for the next 10 years, I'm just going in my account, moving $5,000 plus any gains that are associated with it. You can gift that as well. You don't get any benefits. They get the benefits just because you're gifting them more money. But you could then, that the money you're already going to give is going to come out anyway, but you could be thinking about doing a larger donation to bulk into that. So Will, I think that answers your question. Will's question was, in order to take deduction on the donor advised fund, that you must itemize. So yes, the answer is correct. So that's where donor, after the changes to the Tax Cuts and Jobs Act back in 2017, made it a lot harder for any smaller donations to be itemized. We have to get over that standard deduction in order for any additional amounts above that to be beneficial than just taking the standard. So that's why you see more bulk giving to donor advised funds these days. Donor advised funds, they can work like an investment account. Again, I can choose to move the money in, and when I do, I get a benefit. I can gift them out right then and there, or I can invest it and then gift it out as I'm alive, or a legacy. So I've had some clients where they want to still send money to their organizations that they support for many years after they passed. And these donor advised funds can allow that to happen, where these organizations can still receive a check with your name on it well after you're gone. Okay, we talked required distributions got to come out. It has to happen because Secure Act 2.0 changed it. We always had to take required distributions, but they changed the rules on when. So it used to be 70.5, then it was 72, and now this Secure 2.0 now makes it 73. If you're born 1960 or after, it is 75. Nice thing is, though, is that they've reduced the penalties that are associated with it. So it used to be, if you forgot, you have to take like a 50% penalty on it. So it was pretty severe about not taking it. They've toned it down a little bit. It's only 25% if you do forget to miss it. If you do forget to miss it, talk to your CPA. There should be some flexibility there, but all depends on the IRS, I guess. All right, so here we go. Timing of when you have to start taking required distribution. So if you are 73 in 2024, make sure you get this done. If you just turned 73, actually, they do allow you a grace period to April 1st of next year. But if you do that, you're really just pushing required distributions for 2 years, because you're taking your 2024 in 2025. Oh, and then you also have to take your 2025 in 2025. They only allow that grace period for the first time at the rodeo, which I've never been to a rodeo. We have a lot of Texas people here. I hear it's a lot of fun. We got to get down there. Other things, that I think is worth mentioning, this is complicated, but is also just understanding the rules that are associated with inheriting retirement assets. So if we pass away before the old rules, or when the new rules were here, you can see that there's different ways that monies have to be taken. So if I inherited monies from grandma and she passed before 2020, I had to take just small required distributions off of my lifetime. And so that was just, a smaller amount that I had to take. But now if I get those same monies from grandma, I have to take them out over a 10-year period. So it's important to really understand how the assets that you have are going to flow through to your estate, to those individuals that, that you love and want your legacy to live on through, and just understanding what the impact is to them and their taxes. That ties it up for 2024. So we talked a lot about the tax things that we have to do right now with our workplace, with our college education, with our income taxes, and with our long-term tax planning with things like Roth conversions, and lastly with charitable planning. Let's look to next year. What are some of the things we need to be thinking about? And with a new year, for a lot of individuals comes new resolutions. Life happens, change happens. As we talked about, where you were planning for where you are today, or even in retirement, it might have changed over the last 5 to 10 years. Next year, like any year, can bring change to your situation. So how do you evaluate that? Number one, for a lot of us, the new year brings revisiting our financial plan. Where are we taking our cash flow from? What types of accounts? How does that lead to my current taxes and future taxes? Like we talked about with those Roth conversions. Is my investment strategy aligned with this, with the cash flow and the taxes and the monies that I'm taking? 2025 tax brackets and retirement savings. So understand that with the income brackets, we've seen increases with the income brackets slightly for inflation. So the 24% tax bracket, you have a little bit more of a grace going into next year before you go into, say, the 32. That could be helpful to understand, taxes this year or next year. Retirement savings, assessing, if I want to max out next year, what's the percentage that I need to be saving in my accounts? Those things need to be taken into consideration. Estate planning reviews. So many clients, it's been years. Well, we talked about that Secure 2.0. We talked about how that changes to your heirs. Well, when's the last time we reviewed our estate documents? And are they in alignment with, the new Secure Act? And then I think that one of the biggest things that we're going to be monitoring in 2025, I know we are as a firm, is what's coming out of DC, right down the street, going down the GW Parkway. We have a Republican-controlled government. And so, I think it's fair to say that a lot of individuals are expecting to see either an extension or a permanent extension of the Tax Cuts and Jobs Act, which was supposed to sunset at the end of next year. So what that was is that we were supposed to go back to the tax system back in 2016. For a lot of us, that was going to increase percentages of our brackets, and for some of us, shorten the income brackets greatly. I think you're going to see that extended, right? That's just my personal opinion. But I do think you could see that happen. And I do think that there's going to be even more discussions on other things that surround taxes, such as the state and local tax deduction, right now capped at $10,000. There's whispers, you probably see it on the news as well, that there's talk of that between somewhere $30,000 to $40,000. So that could provide some additional benefits for us. So, and then also with estate, currently right now, the estate number that I can leave, each individual can leave without having any estate taxes associated with it, is around $13 million. $13.9 million, so almost 14. So that was supposed to sunset back to what, $6 or $7 million per person. So, effectively half if Congress doesn't change it. But if, as expected, if they do change it, then I think that might change a little bit how you view your estate plan. If, you're getting to those higher numbers, and how you're thinking about aligning your strategies, like things like Roth conversions and such. So more to see what comes out of DC in 2025. How's the content that I wanted to cover? This goes through, work with a certified financial planner, work with somebody that knows, what they're doing and how everything kind of integrates together. We're here to help. One-on-one financial strategy sessions. The work we do is complimentary. So if you're a client of ours and you want to see some updates, if you want to see how the Tax Cuts and Jobs Acts extensions could impact your plan, let us know. We're working on them now. But if you're new and you want to see how these things, give us a call, let us know. We're certainly happy to help. The work we do is complimentary, really to help educate the public about, what their options are in more of a deeper manner. Again, McLean, Virginia, Houston, Texas, that's where our offices are. So in person or over Zoom, let us know. Thanks for joining, everybody. Any other questions? Will, thank you much. Appreciate the discussion points. Any other questions? Anybody else have? Let me know. All right, guys. I think we're getting to that point. Happy holidays to you and your family. Hope you guys have a great year upcoming in front of you, and best of luck to you. See you guys.